Hello everybody. So today I want to weigh in on MSTY, MSTY. I'm going to tell you my thoughts about it, but before I do, let me just talk to you about the market. So MicroStrategy today is showing amazing resiliency. Bitcoin is showing amazing resiliency. Yet again, really consolidating its status as a stable coin at this point. Bitcoin is still at 85. MicroStrategy is up on the day, and it's on a day where tech is way down, the Nasdaq is way down, and the Nvidia stock, of course, is down 6% because of a $5 billion impairment charge. So to put that into perspective, a stock like Nvidia, a multi-trillion-dollar company, is down 155 billion on a $5 billion impairment charge. I'll leave it up to you to decide whether it's fair or not. I personally think Mr. Market is crazy, and us moving towards this world of digital finance, us focusing on assets that are MicroStrategy, Bitcoin, or that are based on MicroStrategy, like today's asset that I'm going to talk about, MSTY, it's really bringing back some sense to the markets and to these money flows and this entire madness. So very happy about the performance of MicroStrategy today. So let's talk about MSTY. Let's talk about the options engine. And you want to have a big options engine, which is why some people keep talking about MSTY. You're like, oh, it's going to generate me amazing return. It's going to collect the volatility of MicroStrategy for me because I don't want to do it myself. So today's topic is MSTY is taking the internet by storm. Even value investors, dividend investors, they're now weighing in, they're now saying they like it. And what's the product? So what is MSTY? MSTY is writing calls. It's called a covered call ETF, but it's not a real call. It's a synthetic call, i.e., you have two strikes. You have a higher one and a lower one. So it's a form of defined risk strategy. But you're writing a call on an other call that you bought that is way higher in the strike. So it's a higher strike price. Anyways, so it's a synthetic call option strategy where you write calls on not MSTR in this case. You write it on a higher call that you purchased. And if you look at, and I'll go back to the makeup of this fund of MSTY, but if you look at it, you'll see you're mostly in cash. Like you're mostly invested in cash and treasuries, right? And then you have a risky trade on a synthetic call, but it's mostly cash and treasuries. So that's point number one. And this explains, by the way, most likely why a lot of value investors really love MSTY. Because look, I mean, it's just cash, right? Cash is safe, right? Bonds are super safe. This ETF is mostly bonds. Bonds are super safe, right? I mean, come on, that's what finance teaches you, right? So anyways, also, another thing to know is YieldMax, frankly, it's a very successful company. They offer these products on absolutely everything. Like every single stock that retail may like, just even a little bit, even stocks that are not that volatile in my view, like recently Apple's been volatile, but not really, like Exxon. It just writes, it just creates these ETFs just on stocks that are super popular. And I see a lot of very popular stocks. So clearly this is a company, in my view, that is targeting retail and that is trying to sell this to retail because all of the popular stocks are there. And, of course, many of these stocks are popular for a reason. But nonetheless, it's turning, hot stocks into income options. And of course, the distribution rate, and it's key to call it a distribution here, the distribution rate is 83% annualized. So think about that, right? People are so attracted by the distribution rate. People start to think in their mind, and they're like, okay, 83%. So if I own it 15 months, okay, I make 100%, right? I make my entire money back in 15 months. So these assets are very attractive to a lot of people. And and of course, I'm you get where this video is going at this point if you're a follower of a channel, but a lot of people love these assets. So, anyways, point number one is MSTY doesn't own the underlying stock. All right, they own mostly treasuries, mostly cash, and then they have a synthetic call position on MSTR. This stock MSTY, it only exists on top of the volatility of the MSTR options market. It's all about exploiting that options market. It exploits the market of options. It exploits the covered call strategy. It creates the covered call strategy to earn a yield on MSTR, and so this is a good thing for MSTR stock, because one of the top reasons why there is a high price to NAV on MSTR is that a lot of options traders out there love highly volatile stocks for their options engine, because you can't even begin to make a profitable wheel strategy, a profitable covered call strategy. Any options trade, I mean, most options trades are based on having a high octane, highly volatile stock, and so this creates demand for MSTR, the stock, the underlying, the common, that wouldn't exist otherwise. So that volatility is good for MSTR. That's point number one. Point number two is, as you know, MicroStrategy sees itself as a refiner of volatility. It either offers itself more or less volatile options, and the MSTR equity is slightly more volatile than Bitcoin, but they also offer less volatile options like the MSTR preferred, which are less volatile than Bitcoin. And so MicroStrategy sees itself as a refinery of volatility. And where would MSTY sit right there? And I would argue MSTY would sit right at the same level, well, maybe a little less than MSTX and MSTU, but because it still exploits options and is built on options, to me, I would put it out there. I mean, to me, this is still a high octane strategy, so I would put it somewhere in there as a tool. I would not put it as a tool for, say, a MSTR dividend or MSTR preferred, because it's entirely different. We're not paying a dividend or preferred. It's an options premium. It's an ETF that collects options for you and sells volatility for you. So even though, on face value, it may look like you're receiving a dividend, you're actually not receiving a dividend. You're receiving the benefit of an option strategy. And so if MSTX, the benefits of an option strategy is, say, in amplified wins and amplified losses whenever the stock moves, MSTY, the benefits of the option strategy is in that monthly premium that they pay. Okay, point number one is out of the way. Point number two is let's use long term, and let's use the long term performance on and to the best of my ability. The oldest YieldMax covered call ETF that I could find is Tesla, right? And this video is not an endorsement of Tesla or anything like that. It's just that even if you like or dislike Tesla, one thing we need to acknowledge is that Tesla has also been an excellent options engine, right? It's been an excellent stock. Tesla has been an excellent stock to do an option strategy. In fact, that probably was the first stock that people started using to do crazy options on. So Tesla's volatility has been through the roof, and it's been an excellent stock to do an option strategy, just like MSTR. And granted, now that we know that MSTR is here, MSTR is even better. This is the implied volatility as of this Thursday expiration, 92% and 87%. So MSTR still beats Tesla. MSTR is still even more volatile than Tesla. But I think we can agree that Tesla is a close second in terms of volatility. Well, let's look at how TSLY performed against Tesla over nearly 2 years and a half. We have nearly 2 years and a half of look back, Tesla versus TSLY. So you can see TSLY is actually a negative return, minus 0.71%, versus Tesla, 14.66%. So yeah, I agree with a lot of people that say, YieldMax ETFs are more stable. Yeah, they are more stable. In fact, they are so stable that they haven't returned anything. And of course, now that you know the makeup of this, it's mostly cash. Like, look, 46% cash, and then probably the rest, 17% bonds, 14% bonds, 10% bonds, 3% bonds, 2% bonds, right? It would make sense, right? But it would return, the close to cash over a 2.5-year period. And so the performance for TSLY hasn't been very good. And you may say, well, MicroStrategy is a different animal. It's an entirely different animal. When I want to call your attention first of all to the great timing, right? MSTY IPO'd, if we can say it like that. MSTY was launched at a great point. Anybody who would have bought MSTR at this price would also have had an outstanding return. So a lot of that return has to do with the excellent timing that MSTY was launched at. Kudos to them for launching it with this excellent timing. But nonetheless, when we compare over 1 year and let's say 1 year and 2 months, over 1 year and 2 months, the return on MSTY has been 181%. The return on MSTR has been 262%. Again, which one would you rather own? And that's I think a key point here. And of course, as you know, I am all about MSTR, the common stock, the pure form. That's what I'm all about. Moving on to some more key points about MSTY. So the synthetic call option strategy earned a yield in flat or slightly bullish market, but in my view, in a very bullish market, this will underperform because you will cap your upside. You will greatly cap your upside. And it's true that because of a synthetic structure of the call, if you get into a situation where the stock really, really jumps hard, where let's say in a week we have a 40% jump in MicroStrategy, well, in that case, it's true that you've capped your loss. And so you earn all of your loss. I mean, you lose all of your loss. So between the lower leg of the call and the higher leg of the call, of the covered call, right? Between that's all your loss. And once the call that you bought for the higher leg, once that call is out, is in the money, you start making back the rest of the income. So in some instances, yeah, actually the stock shooting up a lot can cap your loss. You have a max loss, but this is rare in my view. This is fairly rare. And at the end of the day, if you have a bullish market, what you're going to get is capped upside because these covered calls are here to earn yield and not necessarily to capture the whole upside. In a very bullish market, in my view, MSTR should outperform. And some argue that in a sideways market, MSTY could outperform, and this is I think this is a key point. People argue that in a sideways market, MSTY could outperform, but if we are about to enter a sideways market, why would the volatility be so high? Right, and this is where one should go back to maybe their MBA days if you happen to have a business degree, or your finance days, and go back to the Black-Scholes formula and understand that implied volatility tells you what the market participants think the stock is going to move. So the market participants are telling you that they think that at some point over the longer run period, the stock is going to move by a lot. And the whole point is that the volatility is so high because the market does not think. Right? The market does not think that we are in a sideways actions. The market thinks that this is a very bullish setup for MicroStrategy. These implied volatility yields are calculated to represent the market's expectations of the performance of the stock. And so that's the very point. It's like, so you're making the bet in a way, you're making the bet that the volatility is wrong. You're making the bet that actually the volatility of MicroStrategy is kind of undue volatility, that, this volatility is because of a news cycle or something like that, and that it is not real, that the underlying asset is not really going to outperform as much as Black-Scholes thinks. And so this is, this may be true for some stocks of YieldMax that they have, but I don't really think that's true for MicroStrategy. I think for MicroStrategy, the implied volatility really represents how the stock is going to move, because if you study the fundamentals, in my view, MicroStrategy is going to move up a lot more. And so in that case, that means we would be in a bullish market. And if we would be in a bullish market, that means that MSTR should outperform. Let me move on with this analysis. Another issue with MSTY is, of course, this is a fund that is heavily marketed, and it attracts investors by giving a distribution. And why did I say that a distribution is important, to call it a distribution and a dividend? Because look, I took a random, so and of course, this is the type of thing that is 5 clicks away to get there. But I looked at just a random month to see how is that distribution qualified, like what is that distribution, right? And so this is the October distribution right here, 1025, 1024, and of course there's this tax form that they publish with the fund for every month, and so you can see that this October 24 distribution estimated return of capital was 50%. So 50% of the distribution, half of the distribution, was return of capital, i.e. they're giving you back your cash. And I haven't gone through every single month, but there are months where you're going to have a lot of return of capital. And when you have a lot of that return of capital, it's simply the fund returning you your cash because they want to keep that distribution alive. They want to keep that distribution alive. And of course, they're going to give you back your cash in months where the options strategy are not as fruitful, where they don't make as much money on options. Of course, on those months, they're going to give you back the cash. Why? Because look, the fund is mostly cash and treasuries. The fund is mostly cash and treasuries. So what you think is money that they've made on options is not necessarily that. It's just them giving you back the cash to keep the distribution. And, no wonder dividends love this. But, dividend investors love this. But I personally have no interest in owning United States treasuries. Absolutely have no interest rate, especially as the bond market is starting to sniff something. And as the bond market is starting to say, oh, wait a minute, are they really risk-free as we thought they were? Right? It's I have no interest in owning this. I'd rather own Bitcoin than all of these treasuries. And unfortunately, MSTI is a slight portion of a fund, is a risky bet on a synthetic covered call strategy. And most of the fund is cash and treasuries. So pretty scary stuff if you ask me. I'm not interested in owning that. So let's go back to the question. Let's assume you actually want to use MSTR as a fuel for income. I would do options myself. That's the way to do it. And of course, you don't even pay the fees when you do the options yourself. So I would just do the options myself. And you know what? If you do those options, you need to be very careful with options because really the options engine for MSTR is driving this beast right here. The options engine is not driving a Dodge Neon. You're driving something that goes pretty fast and you can have an accident with options. So if I did options, I would do the Dodge Neon equivalent of options on MSTR. I wouldn't try to go fast in such a machine, right? What I would do is I would do 0 DTE options every Friday, 2 hours before the close, to tell you how risk averse I am on this one. And my channel, I'm not a risk averse person. I love risk, but for MSTR and for Bitcoin, I've just known this asset for too long. Not to take that much risk. So to me, what I would do is that I would just do 0 day options, right? So options expire on Friday. So you would log in, 2 hours before the close, and then I would sell out of the money. Way out of the money calls 2 hours before the close on a Friday, hoping that really the trend in the market is the trend in the market and that MSTR is not going to pop that much more towards the end of the day. I wouldn't even do it in the beginning of the day. And when I calculate doing this, realistically, I think the yield you could earn doing this realistically by taking a risk that I'm comfortable, which is in my view essentially no risk. I mean, like 99% chance of wins. In my view, I think this strategy could earn a 5% yield for doing that. Okay, it's really not a lot. It's really not a lot. So it could be worth doing depending on how much money you have, but also it could be worth not ruin your Friday and just have a fun Friday and not do this on a Friday. So anyways, it's if you want to have low risk, you can have low risk, and options allow you to really tailor the risk to your own personal situation. But for me, nothing would be worse than actually selling strategy. For me, nothing would be worse than losing the shares. Because for me, and for I think many viewers of this channel, MicroStrategy has been almost a 3-year story for us. And so the capital gains tax bill would be absolutely scary on this, which is why I am never selling my MicroStrategy, never ever, because that capital gains risk would be just too painful. And so, anyways, that depends when you enter the stock. And there's no way, of course, that I would want to own options overnight. That's why I would do zero DTA. There's no ways I would want to own options overnight on a beast like MicroStrategy, right? Especially when you can have a 2 a.m. tweet or some sort of a weekend event that can move Bitcoin, and then boom, overnight there's a tweet out on a 2 a.m. tweet. Yeah, we're launching the Bitcoin reserve. The US bought $100,000 Bitcoin. What do you think happens to Bitcoin? And then the next day, MicroStrategy shoots up like insanity, and then you lose your share because you wrote a covered call a little too close and you were a little too greedy. So this is totally the type of event that I want to avoid, right? So anyways, let's conclude with special considerations. And my friends, I've seen things on X, and you got to be careful, So I'm going to talk about debt a little bit, because I've seen things. Borrow fiat to buy MSTY. Oh boy. I hear that people want to borrow fiat to buy bonds without knowing it, because MSTY is mostly bonds and cash. So you want to borrow fiat to buy an asset that is 46% fiat and another 30% of bond, which is just like fiat, maybe worse if the market gets fearful about bonds, without knowing it, because those distributions sometimes are just return of capital. So let me just say, I'm just going to say it nicely like this. I consider this approach to be inferior. I definitely consider the approach of maxing out cash advances on credit cards to buy MSTY, getting that 80% yield, and paying off the cash advances 35% yield on your credit card. I consider this approach to be inferior, to say the least, greatly inferior, and this is some crazy stuff. So, anyways, be very careful about that. I hear the benefits of shorting fiat, right? How do you short fiat? You borrow dollars. That's how you short fiat. And I hear those benefits of shorting fiat to invest. But in my view, it has to be done wisely. And in order to do this wisely, that means no mark-to-market debt. And I could argue that credit card debt is not mark-to-market debt, but it's pretty darn close. If you stop paying a credit card, see what happens, and it will sure feel like it's mark-to-market. So, anyways. No mark-to-market debt. In my view, the best debt, and this is why I go back and forth on real estate, unfortunately, but the best debt is mortgage debt. Mortgage debt is your best debt. Why? Because it's not mark-to-market. Because if your house loses 50% in value, you still won't be called, right? You won't get wiped out. So I consider mortgages, for example, to be a fiat subsidy, middle-class welfare. Mortgages are no different from middle-class welfare. And even 10% plus interest debt actually doesn't bother me, but the key is it has to be absolutely no mark-to-market, right? So let's say you have a home improvement planned. Instead of using your cash to do the home improvement, it may be wise to, get a personal loan to do the loan improvement, to do the home improvement, and keep your cash to strengthen the account, or, strengthen a brokerage account, or even buy a stock on a brokerage account, because money is fungible, right? But so that doesn't bother me too much, but you got to be very, very careful with things like just borrowing cash advances on a credit card, putting it into MSTY. Very inferior strategy is that, what I'll say to consider, to say the least. And a better idea, and in my view this is the better idea, is to do it backwards, right? Buy, borrow, die. You buy first, and then you borrow against it, and then you die. The buy, borrow, die. And of course, we can't really do buy, borrow, die just yet on MSTR, because TradFi discriminates. TradFi doesn't like Bitcoin. TradFi says Bitcoin bad, and therefore MSTR bad. And despite the stock having had, the best performance in the market of the past 5 years, TradFi still thinks it's bad, and so some brokers discriminate. In fact, most of my MSTR was held at a broker that discriminated against MSTR and gave it 100% margin requirement, so treated like the riskiest of the riskiest stocks still to this day. So I moved it to another broker which gives me a 70% maintenance ratio. But there will be a time where MSTR gets treated like an index, right? There will be a time where it gets treated like a safe stock, where that maintenance ratios will go to say 25%, and then you will be able to do the buy, borrow, die. So the moral of the story is patience. Have some patience. At some point, MSTR, you'll be able to really borrow against it and just fund some part of your lifestyle by borrowing against it. Of course, that is the holy grail of investing. We're not there yet. We'll get there. So hopefully this gives you an idea of what I think about MSTI. Hopefully you find this helpful. This was not investment advice, not financial advice, not debt advice. This is just entertainment. So I'm hoping you were entertained. Please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.